in what appears to be a reversal of the Supreme Court ruling in Absa Bank Kenya versus the Commissioner, which held that such card-related payments are not subject to withholding tax. Among other unintended consequences, the change will likely increase tax compliance costs for banks, payment processors, and merchants who may in turn pass these additional costs to consumers. My name is Michael Othieno. I'm a tax manager at Deloitte. The first change was the proposal to enhance KRA's powers to issue agency notices even where a taxpayer has appealed against a decision by the Tax Appeal Tribunal or a court. This was rejected, therefore meaning that existing taxpayer protections under the Tax Procedures Act are maintained. That means that the KRA cannot issue agency notices where a taxpayer has appealed against a decision made by the Tax Appeal Tribunal or the court. The other change that was dropped was the removal of the minimum deemed dividend provision, where the bill had proposed to grant KRA powers to deem at least 60% of a company's undistributed retained earnings as dividends to shareholders, and that would therefore mean that withholding tax will be due on the deemed dividends, provided that this requirement does not compromise the company's business requirements. The other change that was dropped was the removal of the proposed 25% excise duty on telephones for cellular networks and other wireless networks. The bill had proposed to increase the excise duty rate on these imported products while exempting them from value-added tax, import declaration fee, and railway development levy. While the overall tax on mobile phones was going to be reduced, the downside of this proposal was that the excise duty was going to be imposed upon activation. There was no clarity that imposing excise duty upon activation was well thought out. Based on the report by the Departmental Committee on Finance and National Planning, this proposal was deleted to give the National Treasury ample time to come up with clear rules on the point of taxation. Thirdly, there's the change of VAT status for several products. So the bill had proposed to remove zero rating on certain items such as electric bicycles, buses and motorcycles, inputs for manufacture of animal feeds, transportation of sugarcane from farms to milling factories, supply of locally assembled and manufactured mobile phones, solar and lithium-ion batteries, which were to be made exempt. So the Finance Act 2026 changes were aimed at broadening the tax base, improving compliance, and reducing reliance on rate hikes in line with the medium-term revenue strategy's general direction. But there seems to be apparent delays in the implementation of several key proposals in the MTRS. This is because National Treasury may not afford to take the revenue hit given underperforming collections. Notably, there have been no value-added tax or corporate tax adjustments to align with the rates in the MTRS, that is 28% corporate income tax rate and 14% value-added tax. That is in addition to aligning the top personal income tax rate accordingly as envisaged in the MTRS. The extension of the tax amnesty, which provides a relief for penalties, interest, and fines levied on tax debts incurred up to 31st December 2025, provided the principal tax is settled by 31st December 2026. So the amnesty provides taxpayers with breathing room to regularize their positions without incurring punitive costs. However, it would have been better if taxpayers were given up to June 30th, 2027 to pay the principal taxes. Now, the Finance Act has expanded the definition of management or professional fees to include interchange and merchant service fees arising from transactions that use cards as a means of payment. The Act has also expanded the definition of royalties to include payments for use of digital payment card networks. Effectively, these two changes serve to bring card-related payments and transactions under the ambit of withholding tax, in what appears to be a reversal of the Supreme Court ruling in Absa Bank Kenya versus the Commissioner, which held that such card-related payments are not subject to withholding tax. Among other unintended consequences, the change will likely increase tax compliance costs for banks, payment processors, and merchants who may in turn pass these additional costs to consumers. The tax amnesty is the most consequential deadline in the Act, with a real and finite upside, as it requires settlement of the principal taxes by 31st December 2026. Taking advantage of the amnesty requires internal work done now and not later. This requires reconciliation of historical tax positions, reviewing unfiled periods, and informal arrangements to decide what to bring into the amnesty. The reconciliation work may take months, especially where records are not well kept. So we invite you to join us at the Deloitte Annual Tax Connect, happening in Diani from the 28th to 31st July. See you then.